Why should I continue to be an investor? You may be asking yourself that question after this week and after the volatility that the markets have had of late, but certainly this week underscores that volatility. So we're going to get right to that heart of the matter, if you will, and answer that question in the program. Also going to be joined later on in the program by one of the fellow certified financial fiduciaries at Nelson Financial Planning. Garrett Fields is going to join us with a little history lesson based upon some research that he's done, trying to put some of the numbers that we are hearing about today in historical context, if you will. Certainly that's a good way to perhaps get some context as to the current headlines, because the media doesn't really do a very good job of that now, does it? It's always about who can scream the loudest and create the greatest amount of fear. Never forget that fear as an emotion elicits a 3x response over positive news. The media know that, and that's kind of what the whole concept of their business model is based upon. As my good friend Bud Hedinger, who aptly introduced the program as he does each and every week, said at the outset, one of the conversations we had many years ago was about just that. And he said to me, well, Joel, as you know, bad news sells better than good. And that's certainly the case these days. So welcome to the program, aptly titled Dollars and Cents, where we're going to help you make sense out of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. Before we begin, I have to take a moment and wish all of the dads out there a very happy Father's Day. It is, of course, Father's Day. Happy Father's Day to all of the dads out there. Happy Father's Day to my dad, who occasionally listens to us online from where he lives up in Greenville, North Carolina. I will be getting some texts, maybe some calls at some point today. My kids are sadly scattered on Father's Day. A couple of them still across the pond, and the other one on the other side of the continent for an internship out in Oregon. So anyway, happy Father's Day to all of the dads out there. Also, you may have missed this, but in fact, the market will be closed tomorrow because of a new federal holiday, Juneteenth. So just be aware that the markets are closed tomorrow. That's an odd one. It'll be the first year that that's actually happened. It's odd in that, it just kind of is a new one. And so consequently, it's one that I don't think people are really aware of yet in terms of the federal holiday calendar, but it is in fact a federal holiday, which means that the markets are in fact closed tomorrow. We're going to be at the office as usual, but certainly after this past week, perhaps the markets could use a little timeout, if you will, for at least one day this past week. Obviously, you don't need me to tell you what the headline was for this past week. It was the Federal Reserve raising interest rates by 0.75%. Sort of changed their approach over the past few days. Had been widely expected to raise rates by about 0.5%, 0.5%, which would have been a historically large increase. Instead, because of the inflation data keeps coming out not so hot, the reality is they felt it necessary to raise by 0.75. So that means that it was the largest federal rate hike since 1994. So many years since we've seen that big of a rate hike, and certainly that got the attention of the markets, the media, and everybody in between. Along with the other headline, of course, that was streaming in the media, and that was the notating of the fact that the markets are now in a quote-unquote bear market. We talked a little bit about that on the show a couple of weeks ago. What does that mean? Well, it's just sort of a technical definition. That means that the markets are down 20% from where their prior peak was. So at the end of the day, it's kind of an arbitrary number. I mean, look, if you're down 18%, if you're down 22%, you're still feeling that no matter what. But sometime long ago, the decision was made that 20% is sort of that technical definition of a bear market. So certainly a painful, whether you're at 18 or 19, or in fact this past week, hitting that technical definition of a bear market. So some commentary on that, though, before we get to some reasons to continue to hang in. Remember, over the course of the past 2 and change years, there were, during the course of the COVID lockdown in March of 2020, pretty sharp decline that lasted for about 30 days. That, in fact, also was a bear market. So in case you're wondering if it's been a long time since we've seen something like this, it really hasn't been, a little over 2 years. That bear market was actually the quickest on record. If you remember, all the lockdowns, all the shutdowns, all of that stuff caused everything to really come to a screeching halt. But then after 30 days, I guess it was sort of a realization of, hey, we can all work from home and effectively do the same kind of stuff that we were doing sitting in the office. So guess what? The market responded and the economy responded. Large tech largely fueled that. Large technology companies largely fueled that as demand increased. We were all stuck at home. It was technology that became our outlet, our way to get out of the house, if you will, without actually getting out of the house. But with companies like Netflix and Microsoft and Amazon, we were able to kind of keep rolling along just as we were, and the market responded accordingly. We talked a little bit a couple of weeks ago about the FANGs, those companies, Facebook, Amazon, Apple, Netflix, Google, those companies that were driving a lot of the market performance, particularly over the course of the past 5 years, drove about a third of the performance over the course of the past 5 years. And so part of that, of course, was the dynamic of COVID. And now, as inflation hits, higher interest rates hit, the reality is that those are the companies that are also driving the market downward, because a lot of the decline in the market is actually concentrated in those same sectors and those same companies that also were big drivers up of the overall market. More broadly, if you look at the numbers as of this past week, as of Monday of this past week, 8 of the 11 sectors, economic sectors in the S&P 500. So when we talk about economic sectors, we're talking about technology or communication services or healthcare or industrials or things like that. 8 of the 11 sectors in the S&P 500 remain higher than where they were prior to the pandemic lockdown. We got a couple more thoughts on this when we return. Plus, we'll get to the answer of what to do now and whether you should continue to remain an investor. All that and more coming up on Dollars and Cents. We're talking about some of the reasons why you should continue to remain an investor. Talking a little bit about, first of all, some context, as we like to do. We're also going to be joined later on in the program by one of the fellow certified financial fiduciaries at Nelson Financial Planning, Garrett Fields, with some broader context on 4 different pieces of economic data, if you will. We think it's important, particularly in today's world, to have some context relative to what is going on. Certainly, history doesn't necessarily fully repeat itself, but often it hums the same tune. So we'll have that later in the program. Talking a little bit about context, as we were saying before the break, more broadly, a lot of the market performance over the past few years has been concentrated in large technology. That really accelerated dramatically as a result of COVID. Found a much greater need for those companies that were technologically based to rely on them for goods, services, and basically entertainment during the period of the COVID lockdowns. But if you look at the broader base market, what you find is that there was a lot of other companies that weren't necessarily accelerating upward, but in fact, when you look at the performance, have sort of hung in there decently, particularly over the course of the past few weeks. In fact, as of this past week, 8 of the 11 sectors in the S&P 500, and we sort of talk about the economy, there's different parts of the economy, right? There's the technology part of the economy, there's the communication services, the healthcare, the industrials, those kinds of things. 8 of those 11 sectors remain higher today than where they were pre-pandemic. So if you sometimes pan back the camera a little bit, it's always good to get a broader perspective of the overall landscape, particularly in context with where things have been over the past few years. Remember energy stocks, right? During the course of the COVID lockdown, when oil went to like minus $37 a barrel. Remember that? Like, because the world had shut down and nobody was going to need oil anymore. And so it went negative. I mean, can you imagine that? I mean, negative on the barrel of oil. Well, that happened not more than 2 years ago. The energy companies didn't fare very well in those early stages of the COVID lockdown, but happened to be the best performing sector of the markets these days, about 50% higher than where they were prior to the COVID lockdown. What does all of that mean? Well, it certainly underscores the importance of two concepts which we've talked at length on this program, not just over the past few months or years, but really over the past few decades. The reality is 2 items: diversification, always very, very important, and number 2, rebalancing on a timely basis. The reality is that yesterday's winners will not be tomorrow's winners, and that's why the concept of rebalancing works so well. So here's some data that we thought we might share with you to help you hang in there in terms of your investments and what's going on in the markets today. If you go back over the course of the past 70 odd years, there's been 12 bear markets. So again, bear, 20% decline from the peak of the market. In 10 of those 12, there was in fact a positive return 1 year later. So in 10 of the 12, if you look at the day the market hit that bear, to hit sort of satisfied, check the box for that technical definition, 1 year later, out of 10 of the 12 prior bears, the market was higher. Well, we'd like to end the commentary there and say 10 to 12, that's pretty good, and let's move on. But the reality is that you should be asking, okay, well, what happened in the other 2? Well, the other 2 were 1973 and 2008. Market continued to actually decline over that subsequent 12 months in those 2 particular cases. So we thought it important, right, to talk about the exceptions and see if there are some parallels to the current. Personally, going out on a limb here, we don't think there's not much comparison to those 2 particular instances. Number 1, we'll take 2008. 2008, full financial collapse, a lot of leverage, a lot of borrowed money in the system, right? Pretty much if you could fog a mirror back then, you could get a loan within 48 hours and you'd have cash in hand. There's no shortage of cash today, and certainly there's not nearly as much leverage in the system, particularly on the real estate side of things. So if anything, the excess amount of cash is one of the things that's probably driving inflation. So we don't see it setting up like it did in 2008. Similarly, 1973, if you think back to that, you had some oil embargo issues. You had some inflation issues. Ooh, those kind of sound a little bit more familiar with what's going on here. But the biggest differential that you have to think about is where the global economy is today versus where it was then, where the U.S. economy is relative to the global economy and where the dollar is. And that's the key piece when we talk about the dollar. The dollar is in a much stronger global position than it was 50 odd years ago. Back then, 1973, the Saudis and OPEC decided to just quickly flip the pricing of oil over to gold rather than to the dollar. They shifted the pricing of gold from dollars over to gold. That obviously created some major economic issues, especially in an environment where the dollar was very weak. Here's the reality. Today, the dollar is incredibly strong. Why do we say that? Well, take a look at the yield on the United States Treasuries. Remember, the Treasuries are what the U.S. government issues out to borrow money. Every government does it all around the world. Maybe you could argue we probably do it a little bit more, but pretty much everybody is doing it around the world, whether it's here or in England or in the EU or Japan or China, whatever the case may be. Here's the interesting concept. If you're going to have money in a conservative mix, and if you are an owner of value or of money or of assets around the world, as you survey the landscape, nobody pays a better interest rate still than good old U.S. government bonds, particularly in comparison to the rest of the developed world. That creates a significant position of strength for the dollar. So we while there might be a few more parallels to 1973, particularly with oil conversation and inflation, we think the pretty significant differential is the strong dollar, the continuing ability of the full faith and credit of the U.S. government to pay its obligations, which attracts dollars, which then creates positive yield on its government bonds. Remember, if you look around some of the bonds that have been issued out by governments and central banks around the rest of the world, some of them are still paying negative numbers. And so if you're going to invest money and you want something that's relatively stable, are you going to invest it so you make negative, or are you going to invest it so at least, based upon the current yield on the Treasury, you're making north of 3%? That's the difference. That's a pretty significant differential. So we do not see parallels to 1973. We do not see parallels to 2008. Certainly, when we think about that, we think that this category will fall into that 10 of 12 category, where 10 of the prior 12 bear markets were in fact positive 1 year after the fact. We're going to take a break. When we get back, I want to give you some quick key data points because I'm going to pull Garrett into the program in the next segment, but I want to give you these key data points economically for you to consider, particularly as you're looking at your investments today. Coming up next here on Dollars and Cents with Joel Garris and Garrett Fields of Nelson Financial Planning. Talking in this segment about some of the economic data that you may want to consider if you're asking yourself, why should I continue to hold on to my investments, particularly in light of all the volatility that has happened of late. Also joined in this segment here in a few minutes by our fellow certified financial fiduciary, Garrett Fields at Nelson Financial Planning. Happy Father's Day to all the dads out there. Did you get something good for your dad, or
I did. We are celebrating today, and it's going to be a blast.
All right, very good. Make sure you get them a nice gift too.
Absolutely,
dads like that.
They do. They do.
Excellent. Well, before we get to the research and some of the data points that you've spent some time on this week trying to give some context to what's going out there, I want to just give our listeners just a few tidbits of some things to think about that I would consider to be some clear areas of strength, if you will, when we think about the current economy. We talked in the prior segment about sort of the comparisons to some of the tougher economic times that we've seen over the past 60, 70 years, the 1973, the 2008. Those were in fact the only two bear markets where within 12 months after that hitting of that technical definition of the bear market, the markets were not positive within the next 12 months, meaning that they had gone and produced a positive return over that subsequent 12-month period of time. We think that this one is going to be in the category of that 10 of 12. And here's some of the things that are indicative, or should I say, help us to form the viewpoint that we have. Number one, we talked about this in the comparison to 2008, low consumer debt. Not a lot of debt out there, and so that obviously helps, right? If you've got a lot of borrowed money, when things go bad, then that can really accelerate things going bad. There has been, number two, there has been a decent amount of wage growth. Certainly some of that may be inflationary, no question at all on that, but higher wages generally, pretty good thing, right? You like higher wages,
Absolutely.
right?
I love getting paid more.
That's the reality of it. It also gives people more money to spend. Number three on my list is better retail sales. Now those have kind of started to ebb a little bit as well, but at the end of the day, people are certainly out there shopping, returning to stores, returning to work, those kinds of things. Number four, let's not forget China is finally unlocking, I think, and hopefully that's a permanent unlock. Remember, they, as recently as 30 days ago, had major cities. And when we say major cities in China, it's like 10, 15 million people jammed into a small space, going through full COVID lockdowns, not being able to leave, not being able to go anywhere, trapped at home. As you might well imagine, that does in fact create a little bit of supply chain disruption. So as China unlocks, that should hopefully help the inflation a little bit. Number five, let's not forget the role of dividends. We talk about this extensively on the program. That's sort of the core and has been the core of our investment approach at Nelson Financial Planning for the past 35 years or so, is the focus on companies that are big, that pay dividends. Over the course of the past year, ending March 31, companies paid out $1.8 trillion in dividends, 15% higher than the year before. That's obviously a tremendous amount of payment and income that is coming out as part of as a natural part of your portfolio when you own dividend-paying companies. And then lastly, let's not forget, this country in particular is really, really good at innovating stuff. A lot of the phenomenal progress that we've seen of humankind over the course of the past 50 years has originated from here. In particular, I would draw your attention to healthcare. Certainly there's some interesting developments of late, particularly if you're looking on the lines of some cancer treatments. Some of that stuff expected to be a massive growth industry. Similarly, cloud demand. Remember all those clouds out there? Well, that's how everybody's able to work from home, is by storing stuff up in a cloud. Allows you to work remotely. The growth on that certainly has taken off and will continue to take off. So don't forget, a lot of the innovations out there will continue to propel and drive the economy forward. So we think those are some key reasons why you, as an investor, should remain where you're at. If you're in a diversified portfolio, if you're in a balanced portfolio, then at the end of the day, those are some key factors to be thinking about to really stay the course, if you will. Another reason to stay the course is obviously context.
Absolutely.
Historical comparison to what we've seen in the past. And so you took the opportunity and kind of studied 4 different pieces, if you will, and you've got some interesting comparative data. And I guess that's going to be something here worth noting as we continue the program here.
Absolutely. You know, a lot of this data is really shocking, but I want to start with a data point that's probably not going to shock you. The Wall Street Journal just did a study, and they found that 83% of Americans think that the economy is in poor or bad health. A lot of that has to do with rising mortgage rates, rising inflation, and just the idea that things are getting much more expensive. And that's typically true. And the reason for it is because of something called recency bias. that's whenever you like to take a look at what's happened most recently in your life, and you like to project that forward. So you don't like to go back 10 years or 5 years and say, oh, this is the norm. You like to take a look at what's happened most recent and say, this should happen going.
Yeah, no, that's that sort of the recency bias is a psychological phenomenon that just really underscores the emotional impact or the emotion that comes into decisions when it comes to your money. And certainly we're not trying to sit here and minimize the impact of this market decline on individual portfolio wealth. It has been a significant hit in terms of the decline, no question at all. The point of this conversation is to really give some good information so that people avoid making irrational or impulsive decisions that, to your point, Garrett, is based on looking at that latest experience and saying, oh, it's going to repeat itself. That can often really skew the perspective.
Absolutely. So let's take a look at mortgages first. I mean, that's a big component, a lot of things changing there. Most recently, what's happened is mortgage rates have gone from 3 to 5%. Almost feels like overnight. That's a drastic jump to the tune of, if you were buying a house for around $430,000, you put a 20% down payment, so avoiding PMI, you'd have to spend an extra $400 a month just to afford that mortgage.
Yeah, and the average $430,000 is a good number to use because that's sort of the average selling price of a home in America today. So that would be kind of the normal house that now it's costing you an extra $400 relative to where you were just 6 months ago.
At 3%, absolutely.
But relative to history.
But if you take a look at it, put it in some context, going back 3 years ago, buyers were faced with a very similar dilemma. There was a point where people were actually refinancing down to the 5%. I mean, that was a good rate. And then whenever you zoom out even more over the last 4 decades, we're not even close to the highs. The highs were in the 1980s of close to 16%. So, whenever you take a look at 5% compared to 16%, you're in a pretty good position.
That's almost a bargain, if you will. The reality is, though, I think what people forget is that when all of this COVID stuff happened, all these COVID lockdowns happened, the Federal Reserve went on a incredibly aggressive rate-cutting campaign that, if you look at the economic data at the time that COVID started, unemployment at about 3.5%, economically things going quite well, you really didn't need that low of interest rates against the economic backdrop. Against COVID, sure, understandable. But all that they're trying to do now is still sort of just catch up. They're not even back to where they were before COVID.
But there is some silver lining in this.
There is indeed, and we're going to cover that here after the break. So coming up next here on Dollars and Cents. On the program this week, we're talking about some of the reasons why you should remain an investor despite the craziness of the week that was and the past few weeks in general. Early in the program, we gave you 6 sort of key pieces of economic data to help give you some comparison of some signs of strength or some underlying strength in the overall economy. Also important to have some historical context. There's been 12 other bear markets over the course of the past 70 years. The reality is the last one was just over 2 years ago. In all but 2, the markets were in fact higher over the course of the next 12 months once that technical data point was reached of that 20% decline from prior market highs, which is the technical definition of a bear market. In the other 2, 2008 and 1973, we think there's some significant differences that in our minds suggest that the current situation does not dovetail with one of those 2, but rather sticks with the vast majority, which is that over the course of the next 12 months, you start to see a market recovery. So, talked a lot on the program. Also, join with me here on Dollars and Cents with one of the fellow certified financial fiduciaries at Nelson Financial Planning, Garrett Fields. We welcome in our listeners on a variety of stations throughout the Central Florida region. Also welcome in our podcast listeners as well. As you know, if you are interested in listening to this program during the course of the week on your favorite podcast channel of choice, just subscribe to us on whatever platform you prefer. If you have a hard time finding our channel, go to our website, Nelson Financial Planning. Upper right-hand corner, you'll see a bunch of icons. Click on the one that looks most familiar to you, and you'll get immediately connected over to our channel. So, before the break, we were talking about some comparative data on mortgage rates. We're at 3, up to 5, but 5 still historically low when you think of it from a comparative perspective.
Highest was 16. So, whenever you look at it, low was 3, we're at 5, and highest was 16. We're still, in the bottom third. But there's some silver lining as to mortgage rates increasing. As you take a look at the data, less people are going to be able to afford a house, and you're already starting to see downward pressure on housing prices. In April, 1 in 5 people that put their houses on the market actually had to drop their listing price. So that's some pretty good data if you're looking at buying a house.
Well, and that's exactly right. And again, a lot of these are sort of double-edged swords. Obviously, you're having to borrow and pay more, but perhaps you don't. Perhaps the competition, if you will, for real estate, for those folks that are in desperate need of a house, that they're not going to face 20 offers or 30 offers and have to be $75,000 over list price, or some of the crazy stuff that's been going on. Perhaps some of that might subside. So that certainly could potentially help those folks that are trying to get into a house. What's the markets have to tell us about this from a historical perspective?
Well, so if you take a look at the markets, the Dow Jones hit a all-time high in January of this year. Since then, it's down 15.6%. And that's pretty bad. But when you compare it to some other stocks like tech stocks, the NASDAQ is down about 29%. So, it obviously was fueled by the pandemic where everyone was staying at home. But, to put that into context, over the last 3 years, over the last 5 years, we've actually had 3 market declines of about 20%. You had 2018, you had 2020, and then you have the current decline that we're in. But if you take a look at the return over those last 5 years, the S&P 500, that's still up over 10% on average per year.
Certainly underscores the volatility that has been over the course of the past few years. But if you'd sat on your hands, to your point with that last piece of data, if you'd sat on your hands over the course of the past 5 years, you would have made nothing, sitting in cash certainly. But at the end of the day, it certainly missed out on an opportunity to generate some level of return. Meanwhile, if you get too fixated on what the market's doing on any particular week, day, month, or year, those can certainly throw you off in terms of your investment results.
Absolutely, and you just like you said, so 5 years, that's a little bit of a short time frame. Let's zoom out. Let's go back to 2008, 2009. In 2007, the market had a 55% decline. That Dow Jones dropped 55% during the great financial decline. But if you zoom into 2009, it was already on its longest win streak in history. So, it really does underline to just stay the course and continue investing.
Certainly the silver lining there, which is, I guess, hard for people to really appreciate, is that at the end of the day, a lot of folks sitting with a lot of cash, this certainly could be a nice opportunity to try and employ some of that cash, to invest some of that money, particularly if that's not money that you need over the next 2 or 3 years. Great opportunity to potentially invest that. So we've talked about the mortgage rates, we've talked about the markets. What's next up on a list for comparative perspective, if you will?
So let's take a look at the big headline, inflation. So the inflation numbers just came out at 8.4%. To give some historical context, we like to be around 2%. So we're about 4 times higher than where we want to be, and we hit about a 4-decade high. But to look at it, this is again not the highest that we've seen. You go back to the 1980s, we actually hit 13.5%. So we've definitely seen higher, and the Federal Reserve was able to take care of that. They raised rates and they dampened it down to below 5%. So we've seen worse, but this is definitely bad. To the point that each household is having to spend an additional roughly $311 per month because of this inflation.
Yeah, and I think that's the key piece, is that when inflation is at 8%, there's definitely an impact in household budgets. About the only silver lining there, if you will, is that for those of you that do have some cash and cash savings, finally you may start to see a little bit of a return or a little bit of an interest rate, where for the past probably decade or so really haven't seen much in terms of those interest rates. But certainly inflation can be a dramatic drag, which I guess underscores the point of needing to continue to invest in those asset classes that historically have rates of return that do better than inflation.
Right, so you're starting to see some money market, I-bonds, as you said, savings rates. Those should all start to pay a little bit more, or something, finally.
Right, but also underscores why you don't move out of the equities and stocks that you own, because historically the returns there are the best hedge against inflation. So you have to have that kind of perspective on it. And then lastly, what's sort of the last data point, if you will?
Sure. So last thing we like to take a look at is unemployment. In April, unemployment was sitting right around 3.6%. That's pretty low, especially historically speaking. I mean, we go back to 2020, it jumped up to almost 15%. Now, that was during the Great Resignation, as people are calling it, but definitely still lower than where we were in 2020 by a significant margin. But, as interest rates start to increase and profits start to get hit by this troubling time, you could possibly see that starting to go up. So something that you might want to do, if you're worried about possibly losing your job, is document your wins. If you go in for a review, make sure okay, here is where I'm valuable, here is what I bring to the company, and make sure that you can communicate that to your boss.
Well, and that's a good option as well. Unemployment's still relatively low. 3.6, pre-pandemic was about 3.5. So still some opportunity that perhaps if you're not in the best employment situation to look for better opportunities. But certainly one to be cognizant of. Historically, 3.6% unemployment is incredibly low relative to what the historical trends have been. So that just gives some context on some of the data points that you might be hearing out there in today's world, and also some context on the markets as a whole. We thank you for listening to the program. We're going to wrap it on up and get on out of here. Happy Father's Day to all the dads out there. This has been Dollars and Cents with Joel Garris and Garrett Fields of Nelson Financial Planning.